today we have Mark Walker with us. Mark, thank you for taking time coming back to the show, because the first time we had some technical difficulties. So Mark was kind enough to do the show again. So Mark, welcome to the show.
Hey, thanks. It's my pleasure to be here. Thanks for having me.
Mark, for those that don't know you, how did you make the transition from the corporate side to the real estate boss?
Well, my transition was actually kind of gradual. I started investing as early as 2004 when my wife and I bought a duplex in South Denver. But we ended up sitting several years out, which turned out to be a blessing in disguise because that's when the market correction happened here in the United States and put a lot of people out of business. But it also created a tremendous amount of opportunity for people like me. So around 2010, I started investing again in networking. I partnered with a general contractor to do what we call a scrape, where you actually buy a house, you scrape it down to the ground, and then you build something else in its place. We did that twice between 2010 and 2011. And then in 2011 is when I started buying rental properties again. And I did that because I wanted to create passive income. I wanted to create mailbox money, as we say. So with the intent that I could quit my corporate job. So this entire time, up until this point, I worked for a high-tech company and loved my job, loved the people I worked with and everything, had a great career and was just investing in real estate on the side. Well, towards the end of 2014, I had acquired a modest-sized portfolio here in the Colorado area in the United States, and decided that I wanted to jump ship. I didn't want to work for a corporation anymore. So I went ahead and left the corporate job in January of 2015. And at that same time, too, I had a family member that has done multifamily real estate, apartment complexes for almost 30 years. And he invited me to come job shadow him. And I thought that was really interesting because apartment complexes, and that's more the commercial side of real estate here, those types of transactions go down completely differently. And so I took that as an opportunity to go sit with him and see how those types of deals are done and how those transactions go down. And within that same year, I ended up buying a 64 unit apartment complex. So that's kind of it in a nutshell. It's been a fun journey. I have no regrets looking back on leaving the corporate world, I'll tell you that.
And regarding your first property, can you run us through the numbers?
Sure. So the very first property that I ever bought as an investment was back in 2004. It was right after I'd read the book Rich Dad Poor Dad.
Of course.
And I think, Robert Kiyosaki inspired a lot of us. And so my wife and I went on the hunt for a rental property, and we ended up finding Plex. And in essence, that property had a 36.5% cash on cash return in the first year. Now, when you get that kind of return in the first year, it lights a fire under you. So, but there were some things going on at that time that really caused those numbers to be significantly stronger. 36.5% is really incredible. First of all, at that time in the U.S., you were able to get interest-only loans. On residential stuff, you can get that on the commercial side for a while, but on residential stuff, that's really hard to get now. So that was something that was going on. Also, at the time, I was self-managing the property, so I wasn't paying, a property manager as part of my operating expenses. Doing that, I felt it was an opportunity to learn more about the property management side and all that. And I'll tell you, I think the biggest lesson I took away from that, both my wife and I, was that we never wanted to manage property again. We just wanted to be the investors and the owners. And that's another decision we made back then. And when we started back up again in 2010, 2011, we've always had professional management. But, as far as the specifics of that deal, we also were able to go in with about 10% down. Again, that was a sign of the times. You could go in with higher leverage on something like that. So that obviously helped with the numbers as well.
Gotcha.
So.
And regarding the multifamily one, can you run us through the numbers as well?
Oh, sure. Yeah, the multifamily one, the 64 unit, that was essentially a $631,000 capitalization. So when I say capitalization, I mean everything. That included the down payment, closing costs, some money that we set aside to put into the operating account to, get the property started, and all of that. Um, the property we actually paid $2.6 million for, and we were able to get a Fannie Mae non-recourse loan on it. So we were able to get 80% leverage. And this particular loan was loan to cost, not loan to value. So the difference between loan to value and loan to cost is if you do loan to value, the lender will give you, say, 80% of the purchase price of the property only. However, they gave us 80% of the purchase price of the property plus our first year renovation budget. So they gave us 80% of our money to go invest in the property, to improve it, to unlock additional value and raise the rents. So that was something really encouraging, that really helped with the deal, because for the next 6 to 12 months, we, renovated about half of the units, and we were able to raise the rents pretty significantly.
And
So.
what was the value add opportunities that you did?
Yeah. So as far as the goal and the target went, when we acquired the property, it was about the rents were about 91 cents a square foot per month on average inside the entire apartment complex. Our goal was to get it to $1 by the end of the first year. And we actually ended up getting it up to about $1.10 by the end of the first year. So we completely blew the goal away. However, the way that we unlocked that, and this is a common misconception, I think, amongst investors, you see brokers put properties up on the market for, and they say that rents are significantly under market and a new owner just needs to raise rents. Well, a common misconception is that it's just as simple as buying the property and raising the rents and voila, you're making more money. Oftentimes, I'd say 95% of the time, those rents are low for a reason. They're low because maybe the unit interiors are old and drab, or maybe there's a lot of deferred maintenance on the property. So, to unlock the value in order to raise those rents, we went in and we renovated half of the units. And what we did is we replaced the flooring. We went in and we did two-tone paint throughout. We replaced all of the plumbing fixtures and the lighting fixtures. We implemented a water conservation plan. And a water conservation plan is when we went in and replaced all of the toilets, and we changed out the plumbing fixtures to be low flow, to save water, to get the water bill down. So those are all different things that we did, all with the intent to be able to raise the rents as much as possible, and unlock the value in the property and get a higher return.
Regarding the value add part, because I think for people that are starting out in apartment investing, this is kind of important. When you have existing tenants in place, and when you get in and you of course you are looking at as a revenue source, so you want to increase revenue by increasing the rents. But isn't that a risk to having a tenant turnover because you are increasing the rents?
Yeah, you always risk tenants turning over, but I'll change your mindset. Tenants turning over is not necessarily a bad thing, because if they're not paying the market rent, then wouldn't you rather have someone that is willing to pay the market rent?
Sure,
right?
Of course.
So the turnover is not necessarily bad as long as you can turn the unit over quickly. You want to get your renovation team in there, get their work done, and get out and start marketing the property for a new tenant as quickly as possible. But I'll tell you, as the renovation of the 64 unit property was happening, our occupancy actually never dropped below 93%. And that's actually pretty rare for that to happen, especially when you're renovating a property so extensively. But really what it was is that there were tenants there that had been long-term tenants. And when they saw the finish that we were putting into the units and how nice of renovations we were doing, they wanted to stay, and they were willing to pay more for those finishes. And so, sometimes, if you're doing a good job and you're giving the residents things that they want and they're willing to pay more for, I mean, that's really what your goal is. The turnover isn't quite as bad as you might think.
When you are doing improvements, do you relocate tenants while you're doing the improvements? How do you improve units with existing tenants in it?
We wait for the lease to expire, and when the lease expires, we notify the tenant that we're going to be, raising the rents of that unit. If they decide to stay, then what we do is we'd make it more of like we go in and we'd replace the appliances. That's something that's fairly easy to do. Usually the hardest thing is the flooring. So, sometimes you can work a deal with the residents, if they want to move their stuff, you can replace the flooring and things like that. Otherwise, you could move them to a different unit when their lease expires. So you can go in and do a full rehab. That makes it a little bit more complicated, but there are options like that. And I'd say as a worst case scenario, if somebody, wanted the entire renovation package with the exception of maybe they didn't want the new flooring, maybe you could, work some kind of deal with them, and forego the flooring upgrade. But, typically, the tenants want the upgrades. And so they'll usually jump through hoops, move their stuff out for a day, whatever they need to do in order to get the upgrades. So, but you can be flexible on that kind of stuff.
Gotcha. But you don't offer rent concessions, or do you?
No, I typically don't, especially when the occupancy is so high. Typically there's been only a couple times I've ever done rent concessions, and that's usually during a slow time of the year. Like maybe it's a unit goes vacant around the holidays or something like that, and traffic is really low. But that's pretty rare. Usually we try to time the leases to, come up for renewal at times when it's not a holiday and things like that.
And because in Portugal, the typical lease time is 5 years. So you essentially, let's say both of us are getting an apartment together. We are going to pay 2 months up front, and we usually stay for 5 years. And after the 5-year period, we can get the other added month back and move on our way. If you have leases that are 1 year term, don't you have a kind of always a concern that people might leave, or you never have to worry too much about it?
Yeah, no, that's actually really interesting. I didn't know that in Portugal, the typical lease term is 5 years. In the US, the typical lease term is 1 year. And, I've never been concerned about that. I tend to keep all of my properties really clean and well-maintained. Typically when a unit turns or the lease expires, that resident is usually willing to, sign a new lease at a higher rate. Or if they do decide to move on, the marketing time is typically pretty short. So I typically tend to embrace it. I intend to embrace it as an opportunity to, raise the rent. And, and I'm not gonna lie. Sometimes that's not always the case, but I'd say more often than not it is. So I've come to embrace 1 year lease renewals.
And what are you looking at regarding the quantitative side, regarding IRR, debt service coverage ratios? What are you looking for when let's say both of us have a deal across the table? What are you looking for?
Yeah, typically what I'm looking for, and this is actually really hard to find right now here in the US because the market's really hot. But typically what I look for is I look for a deal that has an IRR of 20 to 25%. And I model that on a 5-year hold. Now, it doesn't mean that in every case I'll hold it for 5 years, more or less, but that's the metric that I track to. I typically also like on multifamily to have a deal that in the first year is going to be a close to 10% or greater cash on cash return. And depending on the upside, in years 2 and 3 and stuff like that, I might do a little bit on that. But for the most part, that's what I'm looking for is double-digit cash on cash return and a 20 to 25% IRR.
And do you look to
when I was buying stuff
Go on.
back in 2000, I was gonna say when I was buying residential stuff back in 2011, 2012, and around that time frame when the real estate market was really slow, it was the opposite of what it is now. I was finding deals for 20% cash on cash return in the first year like crazy. I mean, those deals were everywhere, but they're a lot harder to find now. So, but I'm sure, eventually the market will correct itself again and at least stabilize. But anyway.
And do you look to refi in between the holding period?
Sometimes I do, not always. I've done that on a few properties. I've done it on the residential properties. We're coming up on a point now with the 64 unit where, really at any time I could do it. The property and raise the rents. And so, it would be very possible to, do what we call a supplemental commercial loan and get some cash out of the property. But I haven't pursued that yet, but, probably within the next 6 months, we'll be taking a serious look at whether or not to do that. The thing in the commercial side is typically if you do that, because there's such large prepay penalties on the commercial loans, if you do a supplemental loan, then you're pretty much committing yourself to hold that property until the loan terms out. That's not always the case, but typically it is. So, it's going to be we're going to reach a decision point here with the 64 unit, whether or not we just want to continue to hold it and cash flow it like crazy, or do a supplemental loan, take some of our cash out, and then just have fewer distributions, or even possibly sell the property. But the downside of property is if you want to do a 1031 exchange or defer, the taxes on your gains, then you've got to find a replacement property. And again, that's really hard to do right now if you're a yield hog like me.
Sure. But at this time, and this was my next question, at this time that the market is reaching all-time highs, cap rates are getting a little bit compressed, where are you looking for deals now? Where are the markets that you still find good opportunities now?
I've still been looking in Colorado and Texas, and maybe that's part of my problem, right? Because there are markets out there. I've heard investors say recently that they like Salt Lake City, Utah, that they also like Seattle, Washington, Portland, Oregon, and Phoenix, Arizona areas. Those are the 4 markets that I've recently heard other investors talking about. I haven't started playing there. And the reason for that is because I think that if I was to go into another market, I'd have to really commit myself because I already have properties, in other states as well. So I'm to the point right now where if I want to take on another market, I'd probably have to start cloning myself. So.
But it takes time. You're saying essentially it takes time to build a team, to know the market. So it's a time intensive process. Is this what you're saying?
It is if you do it right. And I think that there's the short term and there's the long term. What you're describing too, I think, is even in the short term. It does take time to build a team and find people that you trust and you work well with together, and that are going to perform. More long term too, I think it's just really important to keep in mind that real estate is something that takes time. It's something you have to nurture. I think it's really easy when you read books and you listen to a lot of the gurus and the experts talk. They talk like they started investing in real estate and they quit their job and they made a ton of money and now they live on a sailboat out in the ocean. That's not always the case. This is something you have to nurture. It takes time to build and establish.
Gotcha. And also, I would like to ask, let's say you have like a newer investor with us and he just has been putting some LOIs, and then you get the usual sketchy financials from the owner. And You get the one-page financials, and the owner immediately says, "Let's go to the purchase sales agreement and give me the escrow amount." So, what would you say in a case like this, that the owner doesn't reveal the tax income property in order for you to actually know if he's speaking the truth or not?
Yeah, yeah, no, you're very wise to question that because when properties go on the market, oftentimes they're trying to make the property look as good as possible, and they might be omitting certain numbers and things like that. And oftentimes in the contracts and stuff like that, sellers are very careful that the language says they do not rep or warranty or represent or warranty the financials that they have provided. So in other words, they're leaving them room to say, I didn't give you the complete picture. What I oftentimes do is, this is another area why going into another market, for example, is no easy task if you do it right. Because when I underwrite a property, I rebuild the P&L. I rebuild it based on what I know it's going to cost me to operate that property. I don't take the owner's financials and assume that those are real, or that's what it's going to cost to operate that property. I literally rebuild it. And if you're new to a market, you can definitely look to a property management company when you're talking and screening property managers. Oftentimes, if they're interested in managing a property for you, they'll provide a budget for that property because they know the area, they know what it's going to cost to maintain. So I'd say, at a bare minimum, you should be doing that as part of your due diligence. But I'd say a second step that's even better is when you know the market well enough that you know what it will cost to operate that property.
But if you don't know, and you're just making an offer based on just a one-page sketchy financials, would you skip the deal, or you just throw the deal to a property manager and say, "Listen, this is what you have. What do you think?"
As part of your due diligence in that case, I would have a property manager provide a budget, work up a budget for the property. I wouldn't even necessarily, I'd ask them to do it independently of looking at the owner's financials.
Gotcha.
Ask them what it's going to cost and give you a budget, and then compare that to the owner's financials and see if you can triangulate on it.
And regarding types of properties, would you look at Section 8 and student housing, or you skip this one sections completely?
There's some people that are very successful with Section 8 and student housing and low income housing and stuff like that. Oftentimes there's extra administrative work related with those types of things. On my residential properties, I have 2 or 3 that are Section 8, and they've been pretty good tenants and stuff like that. But beyond that, I've not, I've never built an entire strategy around, any of the government incentives or programs and things like that. But, and again, that's mainly just because the administrative requirement is usually a lot higher. It's a lot more paperwork and stuff like that. And there's people too that'll argue that sometimes Section 8 people won't treat your property well, and and stuff like that. And I've had mixed cases like that. I've had both cases where I've had people trash units, and I've had people take really good care of the units, and it had nothing to do with whether or not they were on Section 8 or not. But and the nice thing about Section 8 is that you get your check every single month, right on the same day every single month that they pay. The government pays, on time every single month. So that's nice. But, and I don't do it beyond just, a few units here and there.
Gotcha. And regarding team, what do you look for when building a team to take care of basically the whole process?
Sure. I'll speak broadly, and I'll say people that are on my team are other owners, people that own rental properties or investment properties as well. There's a lot of people out there that are professionals, like brokers and property managers and stuff like that, that have never invested in real estate on their own in their life, right? I don't feel comfortable with working with someone like that. I want someone that has been in my shoes or is in my shoes as an owner, and so, I look first and foremost for someone that is also an owner and an investor themselves. And that even goes for the broker that I use. I look for brokers, that are also owners, and know how to crunch the numbers and have been in my shoes. Also, and this relates a lot more to property managers and stuff like that. Obviously, you want someone that knows the area really well. And also when I say knows the area, meaning they can see where to unlock value, right? They know what amenities and features of a property are going to yield the highest rents, the shortest marketing time, things like that. So, and then lastly, I look for people that have systems. People are great, and but I feel more comfortable with systems, with machines, right? Companies and people that have processes for how to do everything. Oftentimes there's property managers out there, for example, that are really good at finding a warm body to rent your property. But when that person doesn't pay on time, all of a sudden that property manager doesn't know what to do. I want the property manager that has a system and a process established for doing the eviction and getting my property freed back up as quickly as possible and remarketed.
And how do you vet them? Because I'm guessing, let's say both of us are partners, let's say, and we are like looking at a property manager to take care of our property. I would guess that you would be saying everything that we would like to hear, right? Because it just wants to get the business, as you might imagine. But how do you vet them? How do you know that these are the guys that are actually going to take care of the property? What are you looking for?
Yeah, I just interview them, and really grill them. Ask them specific questions about their market to see if they know the right answer. Not to say that I do know the right answer, but I want to hear what their answer is.
Sure.
In fact, for anybody that's interested, I have a blog post that I wrote on luxmana.com specifically around how to choose a property manager. And I include a lot of the questions that I like to ask and the areas that I like to focus on. So if anyone is interested in going and checking out that blog post and using maybe some of those questions, you're welcome to. It's on luxmana.com.
Gotcha. Mark, going back, what advice would you tell yourself?
It's funny. When I think back, I think about the properties I didn't buy. And that was, back between 2011 and 2014, the market was completely different than it is today. There were literally properties that I didn't buy because, the cash on cash return was projected to be like 19.8% in the first year. My cutoff was 20%. I said, I won't touch anything less than 20%. And I turned my nose up at deals that were like 19.8%. Today, I'd love to take that kind of deal, so I think about the properties I didn't buy. I might have paid a little more attention to my surroundings, to the actual overall market. And it's tough because back then it felt like everything was so doom and gloom, even for a guy like me that was buying properties like crazy, but I might have paid a little bit more attention to my surroundings and the overall market and said, 19.8, is still pretty stinking good. And that's going to look really good in a couple of years. The other thing is I'd say too, really, if you're looking to take on partners, vet those people, or if you're looking to partner with somebody else or give them money, vet those people, do a background check, find out what they're all about, get some references. I made a mistake very early on, over 10 years ago, where I invested some money with a company that turned out to be some bad people. And I ended up testifying to the grand jury and at the trial for this person, and they were convicted of fraud. So, that was a hard lesson for me to learn, but I call it my PhD in real estate. Fortunately, I recovered from that. I did not lose more than I could afford to lose. But it taught me a valuable lesson. Vet the people that you're partnering with.
I once Portugal's richest person is a billionaire, and it's kind of a Walmart, but here in Portugal. Is still alive. So one day I was actually strolling through a garden, and there he was just sitting. So I just sat down, introduced myself, and started talking. And he kind of gave me some advice, and he started speaking, asked me about what was I doing. And this is interesting what you said, because you know what he told me? In business, you look for two things. This is what he told me. You look at revenue like this. You don't want any fluctuations. You want everything really steady. And you don't want to take highest more than you can chew, basically. You have sustainable steps every single, even if you have like more money, more capital, always sustainable steps. So I find this pretty interesting what you said.
Yeah, no, that's interesting too. And good for you too for just recognizing that person and walking up and starting a conversation.
Just straight at him, hi, my name is Diogo. Would you like to invest with me? He started laughing.
That's
and
great.
said, no, but I would like to know more about yourself. So want to sit down and just have a pleasant conversation.
So you didn't raise any money in that.
No, but I could have because I think he's getting, I don't know, it's like $160 million just in dividends from a company created. So wow. It was like just a conversation. So I learned more about like in those 30 minutes than probably the last year or something. So
that's amazing. Amazing.
It was incredible.
Good for you.
Yeah, it was. I just sometimes I think people have to. It's always like the return of your investment. If you read, if you don't read, if you go out to lunch, and if you choose the people that you hang out with, it's looking for the positive yield. You'd be surprised where you end up with. This is my philosophy in life. Regarding the future, where you see yourself heading and what you've been doing so far, where you see yourself and your company?
Yeah, one of the things that I love about Luxmana Investments is that, I've kept myself and the company really flexible. And so, as I mentioned earlier, the markets, are really strong right now. It's really hard for a yield hog like me to find a deal in this market. But what's good about it is that, my income is passive. I'm not hands-on. I have all of my properties are professionally managed and things like that. So what that does is that frees me up to go look at other places to place capital and invest in and things to do. I'm looking at other possible investments or businesses and stuff like that. Nothing I can elaborate on now, but I'm definitely looking at spreading some capital in other areas while I'm waiting for the market to kind of settle down, or at least flatline a little bit. But obviously, real estate's been very good for me and my family, and so when the right deals come along, I know exactly what they look like, and I know how to unlock the value, and I'm in a great position to pursue those opportunities when they present themselves. So that's kind of where I'm at right now, and just enjoying life. When I started 2017, there were two goals that I set for myself. They were around family and health. I've lost 30 pounds since the start of the year, so I've lost some weight. That's good. Cool. Really focused on my health. I feel a lot better, have a lot more energy. And then on the family side as well, it's been going well. We've taken some trips together as a family. My daughter just started kindergarten this year, and it's just been great. I've been around home a lot more and just spending time with my wife and daughter. So
I think when you reach your 30s, I think at least for me, your brain kind of reboots. You wake up again, you start looking at things from a different perspective, and I think one of the good things about being financially free is that you can enjoy what's really important. What's important in your family, and being healthy and being able to provide value to people around you. I think that's what's most important.
Right.
And
I agree.
Also regarding books, what have you been reading lately? Because I know you were a bookworm like me that you would like to share with our listeners.
Yeah, actually, there's another one I finished since we last talked. that I really liked. It's called The Power of Habit: Why We Do What We Do.
Charles
by,
Duhigg.
Yes, great book. And obviously, I think that's probably on the bestseller list right now. But I just found that fascinating. Have you read that one?
Yeah, yes, I did, and it relates because I used to be 200. I'm 5'6". I used to be 270 pounds. Today I'm 130, and I ran the marathon 4 times now.
Oh my goodness, good for you! Wow.
Yeah, I don't speak much about it now because it's kind of became the new norm. So I like that. I like that book because I read it afterwards, actually, and I found it interesting because it coming from a place that actually I took the path to actually be health instead of financially free, healthy free, and it's pretty interesting because it's I think everything in life is like that. It's always pain and pleasure. It's you just have your mindset wrong, because when you start, your mind starts understanding that you are going to be in a better place if you embrace the pain, because it's not pain at all. It's a good place to be in. Everything changes. It's like something in your mind changes and you start enjoying it. So I really like the book.
Yeah, it is fantastic. So it sounds like we both recommend that as a great read.
Yes.
So
yeah, 5 stars.
Absolutely.
5 stars.
Yeah.
Mark, it was wonderful having you with us today. Just share with our listeners, how can I get a hang of you if they have any further questions and would like to learn more about you?
Yeah, absolutely. And I'll take it a step further too. I'd love to offer the listeners a free gift, just to say thanks for listening to us ramble here for a little while.
Sure.
To get in touch with me, you can learn more at luxmana.com. Luxmana is spelled LuxMana.com. And as a matter of fact, if you go to luxmana.com/Diogo Marquez, then I have a white paper that I've written that I'd love to give you for free. It's about multifamily real estate, and it's called 10 Not So Obvious Ways to Boost Your Multifamily Property NOI. And I talked about unlocking value earlier on in our conversation, and this identifies 10 not so obvious ways to go about unlocking that value and boosting the returns of a multifamily property. Whether you are an inexperienced investor or whether or not you are an apartment investor yourself, I guarantee there's probably at least one thing you'll take away from that white paper. So check it out. luxmana.com/Diogo Marquez.
Mark, it was wonderful having you with us today again. Hope to speak
absolutely.
with you soon, my friend.
Thank you so much.
You're welcome. Have a nice day.